Imagine this. It's a regular weekday morning. You wake up, reach for your phone, and before you've even had coffee, you see it. Red numbers, headlines shouting, someone online saying the market is manipulated, another person blaming billionaires, someone else saying it's all retail panic again. And quietly, without saying it out loud, a thought slips in. If they control everything, what am I even doing here? That thought doesn't make you weak, it makes you human, and it's more common than people admit. Today, we're going to talk about who actually controls the market, not in a dramatic conspiracy-style way, not to scare you, and definitely not to make you feel small, but to give you clarity. Because when you understand how power really works in markets, the noise gets quieter, the panic fades, and you stop blaming yourself for things that were never in your control to begin with. Here's the surprising part. The market isn't controlled by one group. Not billionaires, not hedge funds alone, not governments pulling secret levers behind a curtain. The market is controlled by structure, and once you see that structure, everything starts to make sense. Let's rewind a little. Most people grow up with a very simple idea of the stock market. Companies go up when they're doing well, they go down when they're doing poorly, people buy, people sell, prices move. Fair enough. But that's only the surface. That's the part you can see. Underneath that surface is something far more powerful than opinions or emotions. Liquidity. Liquidity is the ability to move money in and out without causing chaos. And the truth is, the market doesn't move because someone is right or wrong. It moves because large amounts of money need to flow somewhere. Think of the market like a massive highway system. Retail investors are small cars. Institutions are freight trucks. Governments are the road designers. Central banks control the speed limits. And liquidity is the road itself. You can drive perfectly. You can follow every rule. But if 1,000 trucks suddenly change lanes at once, the traffic pattern changes whether you like it or not. That's not manipulation. That's physics. Now let's talk about institutions, because this is where most people get stuck emotionally. When people hear institutions, they imagine shadowy figures making secret deals. But in reality, institutions are boring. Pension funds, insurance companies, mutual funds, endowments, retirement accounts for teachers, nurses, office workers, and engineers. These institutions manage massive pools of money, and their primary goal is not to beat you, it's to survive. They need stability, predictability, and enough liquidity to enter and exit positions without breaking the market. That alone gives them influence. When an institution decides to move billions from bonds into stocks or from stocks into cash, prices shift, not because they want to scare you, not because they hate retail investors, but because size changes gravity. A drop doesn't mean someone decided the market should fall. Often, it means someone needed to rebalance, reduce risk, meet obligations, or respond to macro conditions. And that brings us to the most misunderstood player of all, central banks. Central banks don't pick stocks. They don't care about your portfolio. They don't wake up thinking about your gains or losses. They care about inflation, employment, and systemic stability. When interest rates change, it's not a moral judgment, it's a lever that changes how easy or hard money flows through the system. Low rates make borrowing cheap, money spreads out, risk feels safer, asset prices rise. High rates tighten things, money becomes selective, risk gets repriced, assets cool down. This is why markets can fall even when companies are doing fine, because the cost of money changed. And here's the part that's hard to accept but incredibly freeing. Retail investors don't lose because they're dumb. They lose because they're reacting to signals that were never meant for them. Markets are not storytelling machines. They're liquidity machines. News gives you narratives. Markets respond to flows. When a market drops suddenly, your brain searches for meaning. Someone must be responsible. Someone must be controlling this. But often, what you're seeing is delayed reaction, institutional positioning adjusting, risk being reduced across portfolios globally, algorithms responding to liquidity thresholds. None of it personal, none of it emotional. It just feels emotional because you're watching it with money you care about. Now let's talk about power, because this is the core of the question. Who has power in the market? Power belongs to those who can wait. Institutions can wait because they manage long-term capital. Pension funds invest with decades in mind. Insurance companies plan for obligations years ahead. Sovereign funds think in generations. Retail investors often feel powerless because their time horizon is shorter, not because they're inferior. And that's not a character flaw, it's a life reality. Bills exist, jobs change, emergencies happen. Time pressure creates emotional pressure. The market doesn't punish retail investors for being small, it punishes everyone who is forced to act at the wrong time. That includes institutions too, they just have more buffers. Here's something rarely said out loud. The market doesn't need you to win or lose. It doesn't care either way. It simply reflects the tension between money that needs to move and money that can wait. Once you understand that, you stop asking who's controlling this and start asking what pressure is being released right now. Is money flowing towards safety or risk? Is liquidity expanding or contracting? Is uncertainty rising or falling? Those questions are calmer. They don't accuse, they don't shame, they help you stay grounded. And this is where many people make a quiet shift without realizing it. They stop trying to outsmart the market and start trying to understand their place in it. You don't need to predict every move. You don't need to react to every headline. You don't need to prove anything. You're not late. You're not stupid. You're not missing some secret trick. You're participating in a system that's larger than any individual, and that system runs on structure, not intention. When markets fall, it's not a verdict on your intelligence. When markets rise, it's not proof that someone else cheated. It's the cycle of money responding to conditions. That perspective alone lowers stress. And here's the quiet truth that rarely gets attention. The market rewards consistency more than cleverness. Not speed, not bravado, not constant action. Consistency. Showing up without panic, staying curious instead of reactive, accepting that you won't catch every top or avoid every drop, and that you don't need to. You don't need control to have agency. Control is overrated. Understanding is powerful. So the next time you see volatility, the next time social media starts screaming about manipulation or collapse, take a breath. Remember this. The market isn't controlled by villains or heroes. It's shaped by structure, liquidity, and time horizons. And once you stop personalizing its movements, you regain something far more valuable than certainty. You regain calm. And calm is what lets everyday people stay in the game long enough for the system to work for them instead of against them. Not because they beat the market, but because they finally understood it. If this helped you feel a little clearer, a little steadier, you're exactly who this channel is for. And we'll keep breaking this world down together, quietly, honestly, and without the noise.